Hey guys, this is Mike Agney of EconEmotions.com reporting for the Nemos News Network, bringing you the financial and trading and investing marketplace update for August 19th, 2019. First up, let's go to Hong Kong, where Euronews is reporting that the anti-government protests continued in the rain this weekend, marking the 11th week of demonstrations. Let's take a listen in to what the reporters had to say, as we feel that the Hong Kong civilian base there is going to continue to push and push until the military, the Chinese military, will eventually have to come in and reassert rule here. And but we hopefully it doesn't get to that point. But it seems like these guys aren't going to let up here. So let's see what the Euronews has to report here.
More anti-government rallies in Hong Kong on Saturday have marked the 11th straight week of protests there. Thousands of Hong Kongers, including many teachers, withstood thunderstorms to express their dissatisfaction with the government and police. Demonstrators say they're fighting the erosion of the one country, two systems arrangement.
They are being beaten, and they are being injured, and also they are arrested by the government. We are very concerned about what they are receiving and the possible impact on them in the long run.
I can't really...
So that gives you a little bit of background there of what's been going on and transpiring, but we don't want to see the military come in here, and we certainly don't want to see anybody get injured, but they're definitely fighting for their rights there, and they continue to be at the forefront of affecting our markets globally. So let's keep an eye on that one. What else we got this week, guys? And it's furthermore, here's what David Vance on Twitter said about this. Heads up, Bernie. These people protest the very form of communist authoritarianism that you espouse. As Bernie Sanders posted a tweet, the demonstrators in Hong Kong are an inspiration to us all. It is the right of all people to protest for a better future. We stand with these brave protesters and call on the Chinese government to refrain from violence. Well, that was a great reply by David Vance there on Twitter. And we'll see how this transpires, guys. Just keep an eye on it. See how things move about in the coming week. What else we got this week? The Federal Reserve is Trump's savior, not enemy, as the Jackson Hole summit looms, as all the elites move out to Jackson Hole there in Wyoming to discuss the fate of the plebeian base here globally. We're not sure what they're going to accomplish here, other than we know that interest rates are going to move lower, and the battle between the Federal Reserve and not moving them lower quick enough is going to continue on. Let's read a little bit down here. Let's see what they say here at the end. The president's placing of the blame likely reflects his political acumen rather than economic reality, according to Karen Petro, managing partner of Federal Financial Analytics. The Fed is unpopular with many voters and thus an easy target. Yeah, we agree. They are unpopular with many people, but we also know that they manipulate the markets, and that Trump does not want to see the markets turn south before the 2020 election. So expect further jawboning out of the Trump administration during this Jackson Hole symposium here. And we'll have to continue to watch, as these things do affect our marketplaces considerably in terms of interest rate environment, what to expect there, as well as the what everyone watches, the stock markets. So CNBC put this out of kind of what they're going to be looking at this week. It's tariffs, fiscal stimulus, emerging markets, corporate and government debt. And speaking of government debt, the U.S. national debt jumped $363 billion in just 2 weeks, $1 trillion in 1 year. Well, if you look at this chart here, obviously we've gone from 15 to over 22, probably close to 22.5 trillion now. But you know, this debt ceiling, this is all just a formality. This is not a hard ceiling. Obviously, I don't even know why they even do debt ceilings. Because without the velocity of money increasing, you have to increase the actual monetary supply in order to GDP to grow. So if people want GDP to grow in this debt-based economy, then you got to keep printing money. End of story. That's all you need to know, and that's why we keep seeing this. So, but what's happening is it's taking more and more debt to increase GDP on the same scale. So $1 of debt used to buy us maybe $1.50 in GDP. Now it buys us like 90 cents, let's just say. Something like that. So that's kind of how you have to look at it. It's a law of diminishing returns here, because as debt rises, then your interest payments rise, and interest expense eats into the government's ability to create meaningful and organic goods and services. Not that it's the government's job to do that. The private enterprise has to do that, but they also are increase their debt loads. So that also means their interest expense goes up, and and it thwarts them from capital expenditures and doing what's necessary in order to hire people or to buy capacity in terms of production. So the interest is really a big deal, and it's a mathematical construct, and that's why you're seeing interest rates move lower. It's because as debt moves higher, the interest rate has to move lower in order for the interest expense to go down. So Trump calls for a big Fed rate cut, as we all well know. He criticizes the central banks, and this isn't anything new. We expect us to continue to be at the forefront this year, especially going into the 2020 election. So expect the Fed to be fully politicized here and acquiesce. Whether they go 50 basis points at the next meeting or not is to be determined, but we probably think they will, given the rhetoric coming out of the Trump administration. And it hasn't been so, cheery-eyed for Trump here, as U.S. Steel plans to lay off hundreds of workers in Michigan. I think 200. Let's read here. In a worker adjustment and retraining notification filed on August 5th, this is out of investing.com, the Pittsburgh-based company said it expects to let go fewer than 200 workers following its decision to halt production at the Michigan facility. So all these jobs that he's bringing back in production, yeah, that is the case. The production is coming back here. But you're going to get steel. And I talked to an insider in the steel industry actually today, and the tariffs actually hurt the steel industry. They don't benefit from it, so especially on the scrap side. So expect this is kind of an should be expected overall in the industrial space here. Shouldn't take anybody by surprise there. And speaking of U.S.'s ability of the tariffing here, the U.S. dollar, you can see that this is the picture of the U.S. trade-weighted broad dollar index. It's up here close to actually putting in a new high at 130.3095. So back here early 2000s, we're right back up there. So we heard Jeff Gundlach, a double line this week, talk about how his favorite trade, one of his favorite trades, is being short the dollar below, right below these levels here. So we'll see if this busts out here or not, or if the dollar turns around and the lower interest rate environment starts to hit at the U.S. dollar in the coming month. And for those that think, we hear a lot of talk out in the general public about the U.S. dollar and the bond bubbles, and this is unsustainable. Well, if you really understood our market and the construction of our monetary mechanism system and a fiat dollar system, then you'll know that that's not the truth. And Kevin Muir does an excellent job. This is a Twitter thread that he put out. I suggest you guys read it. I'm not going to go through all of it, but I'll get down to one part he said down here. False bear argument number, let's go with number 2. The U.S. relies on China to finance deficits, and if they ever withdraw funding, the bond market will collapse. Again, wrong. Maybe the Chinese could affect the market for about a month, but as we have seen recently, other creditors would step in, and we'll show you a chart here of Japan in a little bit of how they've been picking up their bond buying. So just go through here. Here, the U.S. dollar will collapse and force the Fed to raise rates to defend it. In doing so, the bond market will shrivel faster than Costanza in the pool. Nope, that can't happen either. If the U.S. dollar loses reserve status, it'll be a gradual affair, and we will expect the other fiat currencies globally to get beat up much more so first. So this was a great Twitter thread that you guys can read through, and this is Kevin Muir, is one of the guys that we highly respect here for his analysis. This was kind of interesting. Let's just watch this one here real quick.
Come on. Into it.
So that's how we view anybody trying to short the dollar and short the U.S. bond market. We're in the same camp of that. So read Kevin Muir's thread there. It's a good one. Go check it out. And speaking of China selling their treasuries, well, look what Japan has just been doing since the stock market started to turn late in 2018. Actually, the stock market hasn't gone anywhere since 2017, but you could tell that they're picking up their highly coveted AAA rated U.S. treasuries to the tune of 122 billion over the course of a little under a year. So China can sell, but Japan will pick them up, and so will all the pension funds and insurers here in the domestic U.S. So here, this is a picture of our. I know this is our QE Forever. We've been using this for probably about a decade now, pretty close till after they passed TARP. Because once they being in fixed income arbitrage is what I did my start of my career. Spent 12 years at a highly respected prop group here in Chicago, and that's what I did. So bonds were everything, and I've noticed that every decade since 1980 starts out with higher rates than where it ends, and it's done in 1980 to 1990 to 2000 to 2010. And now we're going to do it again here in 2020. We're going to start out obviously lower than where we began over here. And so how much lower can we go? Well, if you thought about, let me minus that out here. If you thought about that every decade, you'd been like, oh, we can't get below 8%. We can't get below 6. We can't get below 4. Yeah, we can get below 2 and we can get below 0 and we can go negative. So bonds are a little bit tough for average investors to understand, but all you need to know is that the zero bound is not a actual boundary. You can go negative, and it's what we're seeing around the globe. And basically, why would people pay a negative yield for a bond? Well, because they want the safety. They don't care about giving up a little bit of percentage if they know that they actually they're going to get their money back. So it's kind of like a stealth tax or a stealth fee. And that's what we're seeing around the globe. And the U.S. is by far not moved that far negative yet, but we'll get there eventually as far as we're concerned. Another guy you guys should read is Alhambra Investments here. Jeffrey Snyder puts out an awesome, if you don't read or listen to Macro Voices, you should. He was on there a couple weeks ago, but he also talks about why you need negative yield bonds and how, it's not about the yield. It's about, here, let's just read right here. What lesson might all of the global banking system have learned here? Simple. You better have some U.S. Treasuries lying around in your balance sheet, a lot of them potentially in case things turn in illiquid markets again. You can't risk being caught without what are essentially repo reserves, not bank reserves, but collateral reserves. I own them and I can loan or borrow against them. So here, let's continue on. That's what U.S. Treasuries are, or German bonds overseas in Europe. They are balance sheet tools, and it truly doesn't matter what their return might be. The credit characteristics of the U.S. government don't make a bit of difference. You hold them in inventory because of only their liquidity characteristics. So this goes into the crisis of 2008 and how the liquidity evaporated and took Bear Stearns down and Lehman Brothers. And so we hope to shed some light on there for the Nemos News Network subscribers, that these are the things we look at, and we want you educated, fully educated, because the more educated you are, the more informed you are, and the better decisions you can make. Speaking of the 30-year yield recently, you can see 2018, 2017 to 2019, we sat here at 3%. Now we're moving down to close to 2% again. So that's a huge move. That's a 33% move here. And yeah, so this RSI looks a little bit overdone. You got a little bit of a pop up here, but we're going to get back into here and eventually turn back down as the Federal Reserve acquiesces to the Trump administration, continues to lower U.S. interest rates. And so what about bonds compared to stocks? So what are we talking about here? This chart's from Y Charts here and Barry Ritzold Wealth Management, and it looks at the Vanguard 500 Index total return price percentage change versus the Vanguard Long-Term Bond Index investor total return price percentage change. And you can see since 2000, the bond has kicked its butt. Now, most people don't realize that bonds have capital appreciation as well as yield income, coupon income. And equities, you can see, have underperformed considerably since 2000. And so when people say, oh, equities, that's where you should be, it's your biggest bang for your buck, well, not so much. And this is a chart you can show them. Where we are now, let's look at the SPX here, the S&P 500. You can see we're still below this 29.49 level, well below the highs up there at 30.30, which is a huge level. We get above there, we're going to go a lot higher. So as long as we're below there, the bears still are in control, but we'll see what the Jackson Hole Symposium has in store for any of these stock market shorts that are stuck short down here and waiting for a drop lower. Could they pressure them? Sure. As far as the S&P 500 futures, CME Group E-mini S&P 500 futures, they're trading around 29.20. They were up marginally yesterday with this chart here is from yesterday. And so below this 29.47, just like the SPX, the bears are in control. But can we get above there and test out the highs again? Sure, we could. It all depends on how much money they want to decide to print and upcoming balance sheet buying bonds on their balance sheets from the ECB as well as the Fed. So we'll see. Yeah, we could make new highs for sure. And Northman Trader, we follow him quite extensively. Yeah, I think you guys should too. And so he loves these triangle and wedge breakouts, and so we're still holding. We're underneath his little 29.50 trend line here, and the bears are still in control. But can we get a target apex price appreciation above 3,000? Sure. Would that surprise me? No, because look at the run we've had. It's every dip is bought. Every dip is bought. Every dip is bought. Why would this be any different? We're not so sure it will be. But you can tell that gold has decided to rise. Obviously here late 2018, sitting around the 1,250 level. Now we're up to 1,500. So $250 increase there. Pretty decent move. So, you know, but it's topped out a little bit. Has it gone a little ahead of itself? Maybe. But if the equities, you know, and the Federal Reserve continues to pummel U.S. interest rates, and then this should continue higher. But we'll see. We should, you know, probably get a little bit back and fill here. It has risen quite a bit just from August, you know, $100 rise. So let's see. That might do a little bit of back and fill, as you know, technical analysts we'll call it. And something to consider with the winter coming up, and we're going to show you here in a little bit about a little bit of the climate change lies that we've been uncovering and you know, trying to debunk here. So we'll get involved with that. But September natural gas is starting to, you know, sit around. It's been in a downtrend basically all year long. But with winter coming up, and if it's a harsh winter and we get those cold snaps, then this may pop. So for you advanced traders out there, might be something you want to look at in terms of possible involvement there. So first let's look at, so this is the delinquency rate on credit card loans, which you can see will spike as recession hits, as it went from, you know, looks like a low here of just under above 3.5% and doubled up to close to 7% there in delinquency rates. We've come all the way down here. It's a good sign for the growth of the economy, but we're starting to uptick now. Now this doesn't look like much, excuse me. But this is 2.59% from 2.12. So we're talking about a 22% increase here just over, you know, in the last couple of years. So that's 22% is not small. And you can see how these things accelerate quite abruptly if we do go into a recession and we start missing some payments here. So what does this all mean? Well, you can tell that the credit card companies and the banks are starting to pile on their interest, and that you can see how high this has risen since even 2015 down here below, you know, 13%. So we're up 3% from there. And as interest rates are moving lower and the banks can borrow money cheaper, they're raising the rate to the plebeian commoners. So, you know, this is a little bit uncompetitive advantage here in terms of we thought the Consumer Protection Board would be a little bit more understanding here, but obviously they're letting the banks do what they want to do because net interest margin is needs to increase, or the banks won't be able to fund these downturns that are going to be up and coming, and potential delinquencies that will be exacerbated in the coming downturn. So just keep an eye on this. We thought this was an interesting chart from Statista. Always does a great job of visualizations. And finally, I think in the Bitcoin space, backed from the ICE exchange is about to come online next month. We think this is a great addition to the blockchain ecosystem, the Bitcoin and blockchain ecosystem. And what this does differently from the CME Group's contract is the CME is a fiat currency. Bitcoin settled in fiat, not an actual physical delivered Bitcoin, where the Bakkt exchange will be their flagship product, as we read right here, offering is slated to be a U.S.-based futures exchange and clearinghouse plan for single-day physically delivered Bitcoin contracts, coupled with physical warehousing. So not only are they going to allow you to deliver, but they'll store them as well. It'll be interesting to see what the fees they charge there. So this is coming online, I believe, next month. So we feel this is a big benefit for the blockchain community and Bitcoin in general. So keep an eye on Bakkt there. And as far as Bitcoin today, or as of this chart here, it's 10,700. So still holding above that 10,000 mark, which is bullish for the long term here. And as long as it bases out here and stays above there, I think another move towards that all-important 13,600, a level where if that breaks, I think we'll go to 20,000 relatively in a short few days. So here's the lies that we've been talking about. Let's talk about this. The just reported August 2nd by CBS News. 11 billion tons of ice melted in Greenland just one day. Well, it is summer, guys, right? And we should expect things like that. But climate change is just natural cyclical force of our natural climate, and which is mostly controlled by the big plasma ball you see in the sky, the sun, and cosmic rays, which we're starting to learn more about, and people are becoming a little bit more educated about these things. We're a big study of the plasma and electric universe, so we're not surprised by this these global warming alarmists keeping on, with their disinformation campaigns. But as this next chart will show, that big dip that they were talking about right here, well, now look at it. You can see right back within the 1981-2010 mean here of mass gain. Now this is the Greenland ice sheet here. So if you're not familiar with this, we suggest you go and research the polarportal.org here. They do an excellent job of giving you nice visualizations and actual science and data. And this is when those alarmists put this out right here. And you can see, yeah, it dipped under, but it's gone right back up in a week or two. And you can see how it goes above the mean a lot here during the winter time as well. So guys, just if you don't know, we're moving into a much colder climate over the next coming decades, and it's all driven by solar sun cycles. And don't listen to this disinformation that's being put out by these Al Gore alarmists. Just listen to the facts and do your research, and we hope to bring you more updates like this and keep you abreast of all the things that we think matter. Once again, it's Mike Agney, econemotions.com, reporting for the Nemos News Network, August 19th, 2019. Cheers.